the Julius Rabinowitz Center for Public Policy and Finance. This center will have its formal inauguration in the spring. We're having a big conference then, but we're doing some pre-inaugural events, and this is our very first one. This center, I think, will be a very good addition to Princeton and the Woodrow Wilson School. It will focus on fostering research at the intersection of finance and public policy, something people have become very interested in the last 3 years, and I expect will be interested for some time to come. And we'll also focus on teaching students, both students who are going into business and students who are going into the public sector, about how those two things impact each other. And this seems like in the current environment, we've become more aware that this is something that's very important to have. I am pleased to introduce the person who is going to introduce our speaker, and that is Marcus Brunnermeier. Marcus is the Edward S. Sanford Professor at Princeton University. He is a member of the Economics Department. He's affiliated with the Bentheim Center for Finance, and most recently he's become affiliated with the Woodrow Wilson School. And I'm very pleased that he has agreed to be the first director of the Julius Rabinowitz Center. So it's a real pleasure to have him up here for the first time in his new role, and he will introduce our speaker today. So, Marcus.
Thanks for coming. It's a real pleasure and honor to introduce Professor Weber to give the first talk for this new center. And let me say some few words about Professor Weber. I think he started his undergraduate studies in Germany. He's from Germany, in the southern part of Germany, in Constance. And that's actually also the place where also the monetarists meet once a year. And I was told when he was a young undergraduate, he tried to get into this meeting where the famous monetarist Karl Brunner actually organized these meetings in the early days. And since then he moved on, he did his PhD in Siegen in Germany, and then became professor at the University of Bonn. And that's where actually we met the first time. He was teaching macroeconomics at that time. I still vividly remember how he taught learning in macro models and Kalman filtering, and he compared how useful Kalman filtering is also to shoot rockets to the moon. So this was my first encounter with Professor Weber, Axel Weber. And of course then he moved on, became professor in Frankfurt, in Cologne, and then he became the president of the German Bundesbank. And he was a very powerful member of the ECB board, was generally viewed as one potential successor of Jean-Claude Trichet. And now he's teaching at the University of Chicago this term, central banking and banking. He was a central banker, he's teaching central banking, and he will be a banker at UBS. He is the incoming chairman of UBS, so he knows the second part, the banking component, and we are very grateful that he is coming today, and we're looking forward for a feast. He's known for his straight talk and his clear views on issues, and the floor is all yours.
Well, thank you. It's a pleasure to be here and to accept the invitation. And it's very rare you have former students of yours become professor in Princeton and head a director as director of a center that has just started to learn about the interplay between financial markets and actually the broader economy. But I think that's where we are at the start of what is by many viewed as the first year after the crisis. At least talk like that was around for some time. I prefer to look at it as year 4 of the crisis. And we're not yet done. And if you look at some of the issues related to European crisis at the moment, in particular the debt crisis, and how that will impact, however it's going to play out, how that will impact on the broader financial community and on the banks, you really see how interactive and how intertwined the fate of sovereigns and the fate of banks has become. You already saw that here with the rescue operations for banks here. Looks like we're bordering on the second round of that, and that has major political implications. It's okay if you do things like that once. We always said it would be very difficult to do it twice, and that's where the broader political debate will now be on financial markets, financial market regulation, and risks financial market pose to the taxpayer, rather than the ability of financial markets to deal with risks. I will talk today about the European debt crisis, and Usually when I talk, Marcus was mentioning, I'm an empirical economist. I usually, before I talk about policy, I talk about facts. Because policy removed from facts is very dangerous. So you have to understand, if you want to design good policy, you have to have a good understanding of the problem at hand. It's a bit like treating a patient. If you read the symptoms, but you don't read rightly the underlying cause of the illness, any medication that you apply to the symptoms may simply not work because you don't treat the root cause of the problem. So let's get a bit into the data, let the data speak. I've got many slides, I've put them together from many sources, and then we'll talk about some of the symptoms and some of the underlying root causes of problems. And later on we'll talk about policy on how to do it. This Bings. Oh, this was very fast. Okay. So first of all, when you look at debt, you can actually see the country that is usually associated with debt problems in Europe is Greece. And Greece is over here. That's the 152% of GDP exposure, Greek debt relative to national GDP within a year. That's huge. If you break it down very simply, it's 1.5 years of Greek production income to pay back. If you apply that to any long-term debt that private agents go in, housing debt, for example, in terms of incomes, this is 150% of the Greek income. But they're not the only country that has high debt levels. You can see there's other countries out there. Actually, Japan, 229% of GDP. The number looks worse. The US is just becoming triple digit, 100% of GDP. Anything that's triple digit, in my view, is a problem. In particular, a problem looked through the eyes of financial markets and bondholders. But let's move a bit further. Actually, if you compare debt to underlying wealth and underlying assets of nations, and you look at a concept like net government debt, so you look at some of the assets that counterbalance some of these debt, you can actually see some of these numbers come down a lot. The Japanese number comes down to where the Greek number was before, and actually, unfortunately, we have a very bad account of Greek assets. There is talk about privatizing them, but there's a very bad account on what they're actually worth, so there is no net number that I'm going to post here, but you can actually see for the US it also looks much better. So adjusted for assets, it looks better. These are the primary deficits that currently countries had projected this year. Now what you can clearly see is Greece out there doesn't look like it's got a big problem on that front, but that's where we'll talk later about data revisions. This number is actually sort of a projection early done in the year, probably not going to come around where it is. But if you look at the US and Japan, they're bordering onto almost 10% deficits. Compare that to the high debt levels we had before. And actually when economists talk about both of these things, they usually take the view, a more holistic view on government finances by putting into debt and deficit space a data point that reflects where we currently are. And I put that circle around a set of countries that are in the cloud in that debt deficit space where you don't want to be. You don't want to be there, and you see that the countries that are there for Europe don't just have a debt problem. Debt is usually a legacy of past decisions. It builds up and it can be actually reduced. But the deficits are the speed at which you add to debt. And what is frightening in the current crisis and the workout of this crisis, you saw the 10% for the US, was not the debt level you started with, but it's the deficits that are added now and the deficits likely to be added in the future if some of the programs that are being planned and discussed in Congress and Senate are going to go through. Because if you look at the CBO projection, under some scenario, those 10% deficits are not going to go away for some time. So it's not just the level where you start from, but also the speed and the amount at which you add to this deteriorated situation. So Portugal, Ireland, Greece, and Spain. Actually, some journalists came up with very unfriendly acronyms about these four countries that I wouldn't dare repeat. But That was the countries that in Europe were viewed as a problem because in that space they are in this uncomfortable zone. There's two more countries in there, the blue points, the blue dots. And those two dots are the UK and the US. Much less talked about, but they're there. So that's an uncomfortable situation to be in. Now, I'm going to make the point that whilst that is true, it is largely irrelevant. It's part of the symptoms issue. It's not part of the root cause debate that we need to have about debt going forward. Because when I look at debt, government debt in particular, there's three issues I usually focus on. The one is legacy. Where are we? And where will we likely be projections given current economic behavior and current policy given going forward? The second one is market access. Am I able to roll my legacy debt at reasonable debt cost in the market? And that depends largely on the third issue, that is, I call it the business model of the country going forward. How flexible is the economy? What will future income come from? Is this an economy that is driven by a lot of flexible labor markets and product markets, that is very interactive in the world economy, that has exports and own future production to account for a repayment of current debt levels and whatever was accumulated in the past? And if you go into that space, you can actually see that here, just on many indicators, whether it's product market regulation, whether it's flexibility of labor markets, many, many dimensions, most of these Anglo-Saxon countries, like the UK, the US, or Ireland, are in a totally different cloud than those countries up there for Europe that have very rigid labor markets, very union-controlled labor markets, very little flexibility in product markets, a whole different set of structural issues, and structural is the key word, structural problems underlying the economies that are at the core why a lot of debt has been accumulated. In many of these countries, take Ireland, a lot of the debt accumulated where they're now was actually a reaction of taxpayers rescuing banks in these countries. Ireland had a debt level of 45% to GDP before they came into the crisis. It actually surpassed 100% because over the last 3 years, and that's what the next slide will show us, they've actually did a lot of stuff that was bad for the taxpayer. Now, take the next example if you talk about structural issues. The key structural issue you talk about in policy is how competitive a country is. What share will a country normalize all of these curves to 100? That came down actually to 85. So a 15% accumulated increase in competitiveness of German industry relative to the euro area average. But that euro area average doesn't actually hold for some of the countries that are now being discussed very much in Europe. Take Greece, for example. Actually, if you applied for Greece, Greece has lost, relative to that European average, 10% of competitiveness over the last 12 years. So, if you compare two production locations and the competitiveness of industry, even if they produce the same good for the same global market, there is a 25% difference in unit labor cost and competitiveness just in the ones I mentioned. And actually, look at the green curve. Ireland had lost a lot of competitiveness until before the crisis. But Ireland did a crisis program where they actually regained competitiveness because they cut wages. They actually had a relatively strong structural adjustment process in Ireland that wasn't there in Greece. The turnaround in Ireland happened. And that's why I'm going to make the point later on. Ireland is different to these other countries because going forward, they will regain a competitive situation. Even so, given the fact that financial markets ran well, the Irish economy ran well, and actually a housing boom happened in Ireland, they lost some competitiveness over time. They're going to regain that. They've shown a track record of taking tough macro decisions and getting there if the environment needs such decisions. And they're going to deliver on that. I'm pretty confident. Now, what about the broader picture? Well, the broader picture is that if you look at any of these countries, no high debt deficit country should feel safe. The worst we can have in the current environment is a wrong sense of security about this ability to roll the debt in the market. Because the bond markets are feeble animals. They may just at some point turn on you, and that's going to be a problem for everyone. So nobody should feel safe. Questions about sustainability can arise for everyone. And actually there was some debate over here in the United States, if you remember rightly, when there was a downgrade around the debate of increasing the debt ceiling, and actually where some famous bond investors made some not so positive comments about their own willingness to buy bonds. I think that was a tipping point. We passed that point. It's not an issue now, but it can come back. And so don't rest assured and look over the Atlantic and say it's a European problem. It's a global problem. I showed you the data. Debt is getting out of hand around the globe. Now, having less structural rigidity is a plus. Fine. But if you look at Europe, some of the problems really are, what is the cause of the problem over there and what are the contagion issues? High debt and high deficits are simply, this is legacy, this is how we got there. Substantial funding needs add to the severity of the situation. I'm going to show you some data on that. Market financing costs have skyrocketed. That has impaired current market access, so rolling the debt at low levels of interest rates is a problem. And questions about sustainability really come to the forefront for that. Now, this is how I like to look at the European situation. If you try and understand where we're now, and you try and infer the ability and the prudence of governments going forward to get their house in order, you need to look at the track record for doing that. Now, take Greece and Ireland. They're the most points out there. The blue bar is the accumulated deficit of Ireland and Greece over the course of 2008 to 2010. For 3 years, accumulated deficit. You see what I said before? Ireland has added almost 55% to its deficit over 3 years. In 1 year alone, 35%. Unheard of in European environment before. The other one is Greece, accumulated 35% over the crisis period. And at the same time, you can see all of these countries had the worst growth performance. Ireland and Greece have had economies where actually the accumulated growth of output was negative. They are in a recession, and they're still bordering onto a recession. You could actually make the point in some countries the recession is actually deepening as we go on. Now, understanding where we are, look at the panel above. The panel above tells you the 3 years before the crisis. And you can see many of the countries had experienced unprecedented growth in the years before the crisis. Actually, Ireland had a 17% accumulated growth over the period of 3 years before the crisis. That was a real boom period. Actually, many countries in the world have experienced booms in the 2000 to 2007 period. Actually, output globally grew at a pace it hasn't grown for 25 years since before. So they had a good pre-crisis run. But if you look what some of these countries have actually done in fiscal space, even when they had a growth bonanza, they ran deficits. They actually had relatively large deficits, even in good times. So they had a bad pre-crisis fiscal policy, and they had an even worse crisis. Now that's a combination that is difficult to manage. So you need to go back to a period, and if you want to see the prudent countries that have had good growth runs before the crisis, actually had surpluses. They actually consolidated their budgets. That's what you want to do as a good government. You may want to react in a crisis by having fiscal expenditure, but you have to be in the position to do that, and you can only do that if you consolidate it in good times. That gives you the room to react and to actually have an expansionary fiscal policy like the textbook demands it. If you don't do that in good times, you have a problem with your starting point when the crisis hits. Now, I'm going to argue it's too easy if you just blame governments. If you take the 4 countries, Spain, Ireland, Portugal, and Greece, yes, there was a lot of public sector debt in those years. And if you look, except for Spain and Ireland, That's why I'm going to make the point it's not just Ireland that's different. Spain, for me, is different too. Those countries had somewhat reduced their debt to GDP ratios. And actually, if you look at public sector debt in Spain, it was lower than in Germany. It was at 40% of GDP. We were at 64% of GDP. But they had a bad crisis. And part of the increase, it's the same is not true in Greece. Actually, even their sovereign debt has increased. But look over here. The big problem in many of these countries is, and that's the second circle here, it's not just the public sector that has overspent. It's the private sector that has overspent and run into high debt levels as well. Many of these countries had a building sector boom. And in order to buy housing, where prices have now come down tremendously, they increased private sector exposures and accumulated a lot of debt. I left the US out of the picture because I'm talking a bit about Europe, but I could add similar pictures for the United States. Now, one of the things you see up there is also the 10-year government bond yield, and you can see it's actually skyrocketed for the red line at the end of the sample. That's the increase in sovereign spreads. But if you look at the period 94 to 2000, we didn't have the euro then. Many countries had to deal with relatively high levels of interest rates before the euro, and there was actually no expectation of exchange rate changes kicking around in there. The entire convergence from 1994 to 2000 was a political process of joining EMU and having a common currency, the prime focus of national policy. Everything else was subsumed to the single policy of having the euro. Labor market policies, wage competitiveness, interest rates and monetary policy, exchange rate policies, you name it, fiscal policy, the guiding principle for those countries in those years, mid-90s to end of 90s, we want the euro, and therefore we do everything that is needed to join. And joining was linked to meeting criteria. Having the euro, we also had some criteria and rules, like the Stability and Growth Pact, but nobody, even the prudent countries, obeyed those rules. And if you lose the rules, then you have a different game. Now, here's a sample that basically looks into one of the issues that I find interesting. Let me go back very briefly. If you look at the GDP developments here and the crisis here, I mean, you need to extend that out, and you'll see later that those spreads actually exploded even beyond the 1500 that is on the scale there. But in the early years, in May last year, when we discussed the European crisis, those spread levels have not been unprecedented. They were just new for EMU. And let me mention one thing. The real exceptional part of the European history in finance was not the re-emergence of spread. It was the fact that Greek government bonds were bought and sold at 10 basis points over Bund. Investors believed that the ability of Greece to fund itself in the market, because there was a no bailout rule, basically warranted 10 basis point spread over bonds. Now, that doesn't look like a prudent investment decision. It's being questioned. And with any not so prudent investment decisions, it's the investors, in my view, that should face the financial consequences of those decisions. So bondholders are the ones that should face the consequences of these ill investment decisions and not the taxpayer. And I have a strong view on getting the taxpayer on the hook for wrong investment decisions in financial markets. I'm actually absolutely against it. And I'll come back to that. It has implications. There's no free lunch, but I think first order decisions, you have to get that one right. And so I'm going to go back to this taxpayer versus bondholder. The cost of working out a financial crisis, and I see one sitting here in the audience, the cost of working out such a crisis are huge, and our Asian friends know that. And actually, if you look at some of the workout costs for the Asian crisis or other financial crises we had around Europe, the Korean crisis, are huge. There's 30% of GDP or above. The Irish crisis even cost more than that already so far. So dealing with the financial crisis can have huge implications in terms of cost, both for output lost and for taxpayers' direct involvement. The big problem going forward in Europe is the maturity structure of some of these bonds that are maturing. Because if you look at the amounts that need to be rolled, and we're facing October here, the darkest part of that graph is Spain, there's a huge amount of debt that needs to be rolled by all the European countries, but in particular by the larger countries in the market. And if you dig a bit deeper, you can actually see that what the financial crisis did, it made countries issue, because the cost of issuing were high, it made them issue shorter debt maturities. Though the amount they need to roll, like an avalanche or a snowball you roll down the hill, is becoming larger as the market conditions deteriorate. And there you can see that if you look at the Greek debt, that before the breakout of the European crisis, the average maturity was around 12 years. Now the average maturity is around 3 years. And that maturity is continuing to be less. So a huge amount of reissuings in the market continuously at shorter intervals. And that's why the whole problem is becoming to the front. If you actually look at the bond redemptions that are outstanding, you can actually see a country like Greece, this applies for Greece, didn't have all that much long-term debt issued in the market. A lot of it was very short-term debt. In particular, up to the year 2015, a large part of that debt issuance will be up for renewal, and that's why the financial market is so solidly focusing on it, and that's why continued market access in the workout process is an important issue. Now, I'll skip this. Let me just mention another problem. If banks in a country like Greece are running into problem because the argument becomes banks in these countries have a big exposure to the domestic sovereign, that's just a standard that everybody faces. Of course banks have the largest exposure to the country they do business in. It's the case with every country. And if that sovereign has problems, the banks in these countries will have problems. And if the whole thing develops in a direction where the private depositors are pulling money, I'm quoting here the publication by the Bank of Greece, private Greek depositors are taking their money out of the Greek banks. And actually, if you look at the amount that is happening here, just over the period between when the problems really became eminent in 2010 and the start of 2011, I don't want to go into the most recent history, it was around 30 billion. This is way more than any first dispatchments of European funds into Greece. So the Greek banks are really facing a challenging refinancing environment. Now, I don't want to go into this slide. I've got a few slides in here. Basically, the story behind this is we all know as economists, and we can do that on a napkin, the formula up there, that sustainability simply tells you that what you need to fund depends on your previous debt level, so that's the legacy. It depends also on the interest rate you need to charge. What comes into the picture is also the growth rate of the economy, and if you try and sort of look at that equation altogether, S, which is the primary surplus of a country, is the key ingredient. If you were to do on the back of a napkin that analysis in May 2010, when we discussed Greece, the answer to, given where the outstanding amount of Greek debt was, given where new debt issuance was likely to be, given the maturity profile, and given the level of skyrocketed interest rates, Greece, instead of having a slight deficit in the primary balance, would have had to have a major surplus, primary surplus, bordering onto 12% of GDP. That was not the number they had, that was not the number they're likely to have. So debt sustainability is a key issue here. You need to talk very prudently about whether this is a solvency case or whether this is a liquidity case that can be helped by rolling and helping to roll liquidity in the market. Now, the market has increasingly, over 2011, taken a very negative view on some of the debt in the market, and I've shown you here the UK. These are the spreads that you need to pay to issue debt, and it's not just skyrocketed to unknown dimensions for Greece and these countries. It's actually gone up, even for safe haven countries, like Japan, the United States. Not so much, but there are spikes in some of the issues. Now, what is worrying on the European side is the amount or the number of countries that have faced major increases in their funding costs. The IMF has done a very nice study where they actually take data from the Bank for International Settlement and they look at April 2010, before the European crisis really broke out, and they say, except for Greece, all the countries actually had less than 200 basis points spread over the funding of for their sovereign debt. So 200 basis point was kind of the lowest level of interest rate we've seen. But actually, if you look at the number of countries that are still facing such a favorable environment in the credit swap market, which is the market where you can insure against a default, the default pricing in all of these markets has really gone up. More than 200 basis points is now the rule for more than half of the European Union. So a huge price to insure against solvency risk at the European level. What does Europe need to do? I think Europe needs actions on three fronts. Europe needs first, it needs to stabilize Greece. I kept making the point that Ireland, in my view, has some dimensions which are different than Spain does too. But Greece, you need to stabilize Greece to move on with the problem. You need good crisis management. You need to consolidate and actually work on structural issues. And you need growth, future growth, in order to grow out of these problems. If the whole policy doesn't put in place a model that will give these countries growth chances in the future, they're not going to be able to solve these problems. Second, we need more coordination in Europe. The Stability and Growth Pact basically has largely been invalidated by the behavior of some of the large countries. We need, therefore, much tighter fiscal rules. I actually think the fact that we hoped without a political union, we could have a monetary union, is being invalidated by the current developments. We need a tighter fiscal union and political union in Europe if we want to play a role as Europe on that global landscape. So that's the second set of issues. Moving forward with fiscal integration, having joint decision-making rules for expenditure and revenues, and then we can discuss how the difference between the two, how the deficit is funded, if we have clear rules, how to get our act together in both sides of the balance sheet of a sovereign. And we need to prevent contagion, and basically bank support measures are going to play a role there. Now, when I look at these problems as a policymaker and as somebody who spent 2 or 3 years on the German Council of Economic Advisors, I always try and break this down to a not so complex picture. The picture you get when you read the press is there are zillions of ideas out there. Everybody got a great idea on how to solve this problem. So by and large, this looks very confusing. You have just a letter soup of potential announcements, what could all help, and by itself, each one of them will do. But the big picture very often gets lost in the details of all of these suggestions. So we all know that if you want to take prudent decision in macro policy, adding irrelevant alternatives may change the ranking between policy decisions. I have a view where taking off the table irrelevant alternatives will help you to come to the core decisions and not focus on the symptoms, but focus on the root problem. So I'm going to go through 10 discussions of what Europe discusses now on how the problem should be solved. The first one is we could have a Eurobond, a joint liability. Everybody spends what they want, everybody raises taxes to what they want, and then we jointly fund the difference. You're kidding me. That won't work. Nobody would ever suggest that to domestic taxpayers. A blue bond. You basically decide 60% is a joint issuance, everything else, everybody else will look after themselves. Won't solve the problem either, just adds complications. In particular, it doesn't help those countries that have 150% of debt to GDP ratio. It's not a problem that 60% of that may be funded through European Union channels. It's the other 90% that's the problem. And the high debt, if you break it down analytically into two parts, doesn't really help you if you know one part is going to be solved, if the other part is basically looking for a solution. So I don't think that's going to be an issue. I shouldn't give you too much of my views already because I take them off later. Full fiscal union. The idea is, let's move to a higher ground. We've got a common monetary policy, let's have a common fiscal policy, let's establish a United States of Europe. One of the early discussions of that goes back to the mid-90s. That was actually the German view. You need a single currency can only be the coronation of a long integration process where we've integrated our political systems and then we decide to have a common currency. The other view was, let's have a common currency and the rest will fall in place. Well, it hasn't. So now we're back to the decision, let the rest fall in place, so probably additional political momentum is needed to bring that about. And I think it's a good idea. It's actually what Europe needs to do. Okay, this is just telling you who the big elephants in the room are. This is just taking the European GDP, and if you were to do such a Eurobond, this would be the weights that would be co-funded by each of the governments, and actually, if you look at who's AAA in that group, still the majority, but I showed you before with spreads emerging and downgrades happening in Italy and other places, that number is going down. So there are many arguments either on either side that you can make why the Eurobond won't work, but I don't want to go into it. This is the more bigger decision. This is the 60% you could, below that you can jointly fund. The problem is going to be exactly what I said. It's those countries that have high deficit above 60% that will face the funding problem. So whilst the Eurobond is a great idea for countries that have around 60% debt to GDP ratio, they could co-fund. The large deficit countries have a big problem with that. It doesn't solve their problems. There is a European Rescue Fund. It's been set up. There's two ideas out there. First is, let's increase it. They didn't have the firing power of 440 billion because European governments decided that it should be able to issue at AAA, and you saw before not everybody brought AAA to the country, so actually it couldn't even issue the 440 billion, and there was a decision in July to allow it to effectively issue 440 billion of European debt instruments from this fund, guaranteed by money put in by all of the governments. But it's not a joint and several liability. They don't stand all behind this debt instrument. It is paid by contributions into this fund. Now, there's also the idea of leverage. Let's just provide some capital with this instrument. So it would act like an insurance. It would be like a first loss piece. Bondholders would not face a loss for the first 440 billion of losses occurring in the market because they would be taken by this European instrument. It would be junior to the claims of bondholders in the market. Actually, on construction, it was junior only to the IMF, and taxpayers' money was perceived to be better protected if they took a senior tranche relative to the market, and therefore that was the original decision. Now they're pari passu with the market, that is, they've downgraded, the European politicians downgraded their claims because it was pretty clear if you put a big claim between the market and Greece that goes to European sovereigns, there would be much less left for the market to be distributed. So they changed that because it had adverse pricing effects on the trading of European debt. But you could leverage that. So that's one of the ideas. And why not make it a bank and have the ECB fund that? Actually, when we come to the discussion, this European fund has some adverse dynamics. Down there, I'm giving you a German perspective. Germany's debt ratio before the rescues was 82.3%. We rescued jointly Greece. It moved up slightly. Actually, the entire cost of rescuing Greece, distributed over all the European countries, only added to 2.5%, 3% of German debt to GDP in terms of obligations. So it wasn't a big issue, but it was hugely unpopular. You add Ireland and Portugal, and now Germany is at 87%. If you were to add Spain, because then the larger countries do not pay into this fund anymore, they receive money out of the fund, it has some adverse dynamics for the claims on everybody else that is paying into this fund. We would be at 100%. Remember 100%, 3 digits, that's a number where the market is becoming skeptical of public debt. If you were to add Italy and go down, actually ultimately, Germany would be If Germany were to guarantee the debts of everybody else in the Union, which is sort of just a thought experiment, we would be at 314%. By own decision. Again, I don't think anybody would put that in front of taxpayers and voters. So the process that we're outlining here has some very adverse dynamics on potential liabilities of countries and taxpayers that everybody understands too well. And that's why some of this stuff really happening has such a low probability, you might just as well take it off the table. That's my policy approach when I deal with these problems. Now, this is going to hold some clue on what I'm going to say later on, where some of the solutions lie. Given the fact that everybody else drops out, the two countries that are at the core of funding this will always be, and have always been, Germany and France. Given that we already had 3 rescues, you can actually see that the joint capital weight of Germany and France in that European fund that was below 50% is now above 50%. So if that fund were to run on majority voting, as soon as and as long as Germany and France were to agree, it's a done deal. And actually you extend that out to a number of other rescues, you can actually see that it doesn't need a lot of countries with added problems till actually Germany and France would have a 2/3 qualified majority for taking some of these decisions. And given this endogenous shift, as more countries have problems, the weight of Germany and France increase in some of these bailout decisions, that's not surprising that given this dynamics that is built into the mechanism of the fund, that something that was very unpopular in Europe, a beach walk of the French president and the German chancellor, which before a meeting of the European peers, they discussed and agreed on some joint action, was part of the new coordinating mechanism that we didn't have so explicitly before. Being the majority shareholders, if they agree and can reach some agreement, many things go forward. And that's what you see more and more now. You had this press conference just 2 days ago in Berlin of Sarkozy with Merkel. Again, announcements were made on how Europe will move forward. But that was a totally different political process than discussing that on the side of an EU Council in Brussels. The economic weights in the Union are shifting endogenously. Like it or not, that's simply determined by the ability to fund those problems down the road. We have to take note of that process, but we have to find a structural way to deal with that political process, because it has to be legitimate. It has to be something that leads Europe forward in a way that is productive. And we need to discuss that. Now, there are other great ideas. The ones where I'm most violently opposed is let the ECB move in. The ECB should do large scales of sovereign debt purchases. Actually, my view is we, as a central bank, are the lender of last resort for the financial sector, for banks. We're not the backstop for governments. The ECB could do full-fledged quantitative easing. Again, a lot of discussion in the market about this, or even the debate, the IMF could buy European bonds, or the Brazilian, the Indian, the Russian or Chinese governments who have huge amounts of foreign exchange reserves could buy some European bonds. You see, all of this stuff on this page is viewed from a government side. Let somebody else take the decisive action to solve the problem, but not me. That's not a useful way forward. And basically, if you look at some other issues that are still discussed, there could actually be some sort of restructuring of Greek debt. Some compare it to a managed default. The question is there such a thing as a managed default? Can you actually do it? What are the contagion risks from that? Brady bond was a bond that worked. Estimates in the market are 60 to 80% of bond losses in a negotiated bond swap involving Greece. So these are big numbers. And therefore, the lower point is, well, if that happens, you need to immediately recapitalize European banks, because European banks are largely holding some of these peripheral bonds. And there are a number of estimates out there. I don't want to own any of these estimates because you have to really go deeply, but the IMF has come up with estimates. The European have announced estimates. There's a number of these around. If you just look at performance, European banks and global banks have raised 100 billion of capital this year. The numbers we discuss in Europe are typically larger than that. Now, here's the problem if you look at what that will mean for particular countries. Actually, if you look at financial sector debt and if you look at sovereign debt, in many countries, financial sector debt is only a small fraction of the overall balance sheet of the government or relative to GDP. But there's some countries like Ireland where actually the banking sector relative to the size of GDP has grown out of proportion. Resizing and realigning the size of the country with the size of its banks is part of the program here. Not for those where it's in some ratio to the banks and the sovereign or the GDP, but here for these countries it's definitely part of it. When you talk about contagion, you have to know who will feel this contagion. So if you take selected US and European bank exposures to Greece, you can actually find that, yes, Germany does have some exposures there, but actually the exposures of French banks are large, and actually even US banks have a large exposure to Greece. So if you're talking about a solution that involves some debt restructuring in Europe, in Greece, this will not be neutral to the way this will materialize over here, because also US banks and money market funds have exposures to these countries. They hold those assets, so they will be part of this workout process. And they have to be on board. If you look at the US banks' exposures to selected countries, you can actually see that for Greece, Portugal, and Ireland, this is not such a big issue. But when you come to the large country, it becomes a larger issue. Actually, if you look at the numbers here, these are no small numbers. If there is a debate about sovereign workout processes, it will mean that there is also a major impact on US banks. So when we're discussing restabilizing and again stabilizing the banks, it's not just going to be a European program where you need those things in place. It's a more broader problem, so it all depends how this is worked out, and authorities are discussing this at the moment. Let me skip the rest, but here is one important issue: money market funds. Money market funds are frequently discussed when it comes to potential impact on spillover effects, because it's not just banks that have exposures to Europe. It's also money market funds that have been interbank, that have worked in the interbank market to provide liquidity, and those exposures are sizable as well, in particular when it comes to some of the exposures, say, of the French banks relative to the German banks. You can see the numbers that are there. Overall, for the euro area, it is pretty large, around 300 billion. Now, let me just skip a few things, or let me just maybe mention this thing. This is a graph taken from the IMF's recent financial stability report, where they say, relative to the size of the original problem, the impact of contagion by these problems not being solved early on now amounts to something like 300 billion euro contagion effects rather than primary exposures. And this is basically how uncertainty about sovereign bond trading and the increase in CDS spreads and sovereign bond prices has affected in a negative way equity markets and valuations on equity markets, so stock prices tending down. But there is no direct link to the exposure. There is an indirect link through the banks into these markets. So there are a huge number of additional markets being impacted upon by this crisis still prevailing. And the number that the IMF comes up with is roughly the contagion effect is, again, something like 300 billion. The Europeans have embarked in making a stress test part of the judgment on who will be and what will be the effects, who will be the banks and what will be the effects if there are some risks in the European periphery. Now, just again, big picture, no details. Under international accounting standards and under international banking supervisory standards, similar rules apply to what capital banks need to hold debt in their book. It's called Basel III. We had a former standard Basel II that was improved upon. And actually, if you do a stress test where you stress some of the peripheral countries in Europe, you can actually see that more than half of the European banks, if you do such a stress test of calculating what an impact of haircuts would be on European banks, half of those banks are not any longer in the green zone. They're in orange or beyond. So that means there are a number of banks in Europe where a stress in the periphery, if it were to materialize, and if there was a workout process, would impact these banks and suggest that once they slip below these 6, 8, or 10% line, mention your aspiration level, you have to recapitalize them to be above again. So recapitalizing European banks, if we have a workout process in Europe, is going to be absolutely key to making it possible to actually restructure European debt. If you don't commit at the same time to recapitalizing banks, you will find some problems. So again, back to the overall picture, try and reduce the complexity. My view is there's a number of irrelevant alternatives discussed that distract from looking at what really needs to be done now. So take all this stuff off the table. Forget about Eurobonds and blue bonds. It's a theoretical debate, no European taxpayer will be behind it. Forget about increasing, at the moment, the European Rescue Fund or leveraging it, because there is no agreement exactly on how this is done. If you look at short-term action that you need, and if it goes in the direction of doing something substantial, also take out the ECB. The ECB has been in a function of building a bridge. It cannot be a bridge to nowhere. Governments need that other pillar of the European banking and sovereign rescue programs to be built in fiscal space. That European pillar of solving the problems by the European sovereigns since 1.5 years has only one sign on it: under construction. And that's not really useful after such a long period of time. Let me also very briefly say, forget about the hopes that others would be drawn into these problems, like the IMF, more than they are now already, or that the BRIC countries may solve it for you, or China miraculously buy some of these bonds. So don't focus on those things that are nice, where others take action instead of sovereign European governments themselves. Take that off the table and see what you're left. About all the stuff that is being discussed. There's 3 things left. There's one discussion about full fiscal union. And I think that, in terms of long-term where we need to go, is absolutely right. That's what we need to do. But it's long-term. The talk had the title, Opportunities and Challenges. We talked about the challenges. Every crisis also offers opportunities. Everybody thought European Union and fiscal integration and political integration would come about as a result of having one money. So to say, a byproduct. It doesn't. But if we make the problems that are now there the root cause for further action in integrating Europe, it actually may lead to something good. And I think Europe needs to find its way around the global table. And I can tell you, I said on many G7 and G20 tables, the perception of Europe is one where Europe will only count around that G7 table if it's united. To have 3 countries from Europe there in different seats, the Commission and everyone, the feeling around the table is still the same discussion we had in the past, where the whole idea was, what is the phone number of Europe? Europe needs to move forward as a result of this crisis and integrate more. But that's a long-term objective. It needs long political processes, so it's not an imminent solution. It helps for a credible commitment that, yes, we will work on our problems, but it doesn't solve your imminent problems. So what do they need to do? In my view, they should look at making bondholders part of the workout process. They should restructure Greek debt, and I said that from the start. And if that is done, we have to probably bite into the bitter apple of, again, making sure that that doesn't impact on the citizens and on their deposits in banks, and therefore bank recapitalization on the heel of negotiating such a restructuring would be immediately what needs to be done. Now, when it comes to rescuing banks, I would make the point, we've been there before. We know how to do that. It's not so difficult. There's a number of instruments. The first thing is recapitalizing banks you actually need to put more capital into banks to make counterparties feel safe with their money in the banks. And counterparties are there in several dimensions. One is depositors. They need to feel reassured that their money in banks is safe. Now we have deposit guarantee schemes, but more capital to absorb losses in the operations of banks is a very important line of defense, and that needs to be reestablished in its credibility. It's the real issue about ensuring solvency of a bank, and actually if you look at the philosophy of Basel III, that's where we improved and increased the capital standards for banks tremendously. A bank could run on something like 2% minimum required core tier 1 capital. But actually when you looked at capital definitions, some of the stuff that counted as capital wasn't really fully loss absorbing. So 2% capital in some of the large banks was a minimum requirement. The new requirement going forward will be above 10%. So it's increased a lot. But you need that after this financial crisis to make counterparties feel that this is a safe bank. Capital is a synonym for a loss absorption that banks need to have after we realize that losses can be huge. The other thing that needs to be done is we need to make sure that the interbank market remains liquid. Actually, the interbank market is frozen on a transatlantic scale and on a European scale. So that interbank market needs to be liquid. That's where the ECB comes in. The ECB is an institution that guarantees and ensures liquidity. It's not about solvency, that's a fiscal issue. And that's where I see the ECB's main action and extending maturities of operating procedures. It all works to make sure that liquidity is there. And basically, I want to leave that thought with you. Maybe it's not a good idea to rescue banks in their current size. Maybe it's a better idea, now that we have a new round of legacy assets, of impaired assets. The first round was all the MBS, mortgage-backed securities, CDOs, CDO squares, structured finance products. The markets turned illiquid for those, and many banks, because they couldn't sell them, there was no buyer, put them on maturity vehicle to ride out the losses over time. There's now a new set of illiquid markets that we're discussing, and so probably a new round of placing these assets outside balance sheets of banks would help. What does that do? It reduces the size of banks tremendously. You may have heard of a German lender called Hypo Real Estate. They had a balance sheet of 400 billion. After we placed illiquid assets into a maturity vehicle and let the equity owners of that bank and the bondholders take care of future losses in that maturity vehicle, the bank was half its size. So if you have the feeling that a space like Europe is overbanked and overbranched, maybe reducing the size of banks going forward is one of the issues. And that's all of the debate you will have over here, and you do have over here, about the Volcker rule and about some of breaking up the banks into a retail-based part and into an investment bank that can easier be wound down. It's all about the issue of, all the issues about systemically relevant global banks, so-called SIFI banks, is all about the fact that many people have grown uncomfortable with the current size of banks. And having operations, rescue measures that will reduce the size of banks, in my view, should always be part and parcel of any solution. So place some maturity assets out there. The way you do that, as long as a bank does new business, it needs its capital to operate as regulatory capital. Once you don't allow a bad bank or a maturity vehicle to do new business, it can actually take its former regulatory capital as a loss-absorbing capital to ride out losses in these bad banks. And that's what you need to do. You need to basically keep the equity holders of those banks on board, not just dilute them, but keep them on board to face and answer for the losses that occur with past investment decisions on legacy assets where the market is turned illiquid. So I think that's basically what needs to be done. Take a lot of irrelevant alternatives off the table, focus on the key things, keep bondholders in charge of their wrong investment decisions, restructure and reprofile, and renegotiate some of the debt at the cost of bondholders, and where banks need to be recapitalized on both sides of the Atlantic, do just that. And I'm going to end here. Thank you.
Thanks a lot for the talk, and now we open for some questions. I would only ask you to go to the mic so everybody can hear you. So if you have any questions, please raise your hand and walk to the mic.
Thank you for that talk. Isn't it true that if you raise the capital requirements of the banks, their profits would go down? And isn't that why they resist doing it?
Okay, well, you see, the regulatory standards why the capital requirements were raised was simply acknowledging the fact that banks were undercapitalized under the recent standard. And of course, it does exactly that. If you require banks to hold more capital and with an unchanged balance sheet, it basically reduces the return on equity that some of these banks have. Actually, investment banking, because some of the rules that apply to the trading book of investment banks have an even stronger impact on their profitability going forward, as some of the retail banks will feel from Basel III. But that was, in my view, not an unintended consequence of the new regulation. It was the core of what needs to be done. Basically, banks that would post a profit objective of 25 return on equity probably have to live with returns on equity that are well below that, surely half of what that is. Now, that doesn't make banks unprofitable, it just makes them less profitable, and I don't see a real big problem with that.
Just one other question. Do you subscribe to any theory that there would be like a domino effect, that if Greece would have failed, then other countries might have the same kind of a problem?
Well, I try to say that if you look at symptoms only, it may superficially look like that. If you look at core problems, you actually can see that some of the countries in Europe that are always mentioned jointly with Greece are in a totally different macroeconomic environment. As long as we keep giving the message that they will all receive the same treatment, I think we're kind of adding to that perception that none of these countries are alike. I think Greece needs a totally different process of working with their problem than some of the other countries, because their own contributions, the other countries' own contribution to solving their problems is larger. If you look at debt sustainability in a country, I don't want to mention Greece, if the IMF were brought in, and it was in Asia and America, in the Americas, to deal with a large debt overhang in these countries, if their feeling was that this debt, given where interest rates, where growth rates are now, and where primary surpluses were, is not sustainable, they would demand a restructuring of that debt before they started working with the country altogether. So what I'm discussing here is just basically acknowledging that fact that the first thing you need to do with high legacy debt is bring it to a sustainable level, and then you can focus on a workout program. That step is still missing in Greece.
Thank you.
Thank you for the fascinating overview. There's just one question left. If the picture is as crystal clear as you have described in the last 1 hour, why is policy not following all these advices?
Well, that's
I want to have your true answer to this.
No, I mean, look, I mean, basically you have to ask policymakers that. My job, if I talk with my students or if I talk in an audience here, my job is not to add to complexity. My job is to try and sort of take a lot of irrelevant alternatives away so you can actually start seeing some of the real fundamental problems. Sometimes you don't see that too clearly if complexity is too high. And so what I try to give you is my own opinion on what options should be off the table. You get totally different views. If you ask a market economist on what he thinks the ECB should do, he would tell you they should buy the bonds. Well, yes, I can understand that. I understand how a market economist functions. But if you really try and look at what are the key issues that now need to be solved, it's first order approximation. Greece hasn't been solved yet. It is still a lingering problem, as it wouldn't be in the news every day. And the second issue is if we solve it in the way that I mentioned here, by restructuring rather than by continue to fund, then the banks have to immediately be part of that joint action. Everything else will have to come later on. But that's, in my view, the first action that needs to be taken. I don't know why governments... I'm not part of that decision-making process anymore.
The Financial Times is reporting late this afternoon that the European banks, especially those in France, are going to elect to shrink rather than to raise capital. The reason being that capital is way too expensive, with the book values being what they are, the price to book being what they are. As a policymaker, how do you, obviously if they shrink, they're not adding capital, their ability to absorb the restructuring, the debt restructures that you talk about are not really there. As a policymaker, how do you get them to raise?
Former policymaker.
As a former policymaker, although you will be a policymaker in a private setting in a year or two from now.
Right. Okay. Well, I think why I put up this slide about, first of all, the exposures that you would have also among American financial players, including American banks or money market mutual funds, was simply to show that this is a universal problem. The global financial system is so intertwined that you cannot take a myopic view at just a country. The second issue that I put up and tried to convince you about was maybe rescuing banks in their current size and therefore doing a calculus where you ask yourself, how much capital do I need to fund the current size of bank's balance sheet is not the best approach. Maybe an approach that goes in the direction of what the FT has just obviously picked up and that I've been sort of, that's what we did in Germany. We asked ourselves, how much of that bank do we want to be there in the future and how much needs to be placed outside the actual continuous operations of that bank that needs to hold regulatory capital to bring that bank down to a reasonable. And I believe if you read again what policymakers say about the core of banks that they're interested in, it's the deposits. Actually, if you look at the FDIC discussions, the FDIC is all about, let's find a bridge bank, let's put the deposits there, let's put the required capital there, and let's provide liquidity to that transferred bridge bank that would make sure that the depositors don't suffer. The rest, the investment portfolios, there is increasingly the view that this should be wound down in a waterfall of responsibilities. The first losses to be taken from any such downsizing will be with the equity investors in the bank. So it's the owners of the bank that have to basically be in charge of those losses. And then there's a big debate how hybrid capital, that is not bondholders, but some instruments that are a hybrid between bonds and capital, how they should be part of the workout process. And the big question is, do you make bondholders, bank bondholders, unsecured bondholders of the bank, part of that workout process? Let me just say, in Europe, the consensus so far has been, and in the US, let's not touch the issue of unsecured bank bonds at this juncture. So I think the whole thing would stop with making equity holders pay for necessary recapitalizations of the banks or for winding down balance sheet. And that's pretty much what we did in Europe. And so these asset vehicles, these asset exit vehicles, will send the bill every year to that bank depending on the losses that are posted. The main reason to put these assets outside the bank is if you sell them now and there is no buyer, you actually maximize the loss you realize now. So basically hoping for these markets to come back and for some of these assets to have a continuous payment stream would actually justify placing them out. So as long as the asset pays interest and as long as you have the hope of the principal being repaid at the end, placing them out over the maturity of the underlying bonds is a preferable strategy because it basically needs less capital now. But ultimately, you shouldn't kid yourself. Losses will materialize down the road, but distributing losses over a period of years is sometimes better than actually materializing all the losses up front and phasing them down.
That's an interesting comment, but you showed a slide that showed that as a result of not facing up to the problems a year or two ago, the cost
will be there.
Has grown exponentially.
Yeah, absolutely. I mean, so I'm not saying that there is There's two alternatives. One is you place that stuff out and you face a small cost every year, but the cost will come over years, or you realize all the costs up front. If you would have a huge amount of equity investors that would like to invest into a bank now, the better solution for that bank would be to realize all the losses up front and therefore generate some new fantasy for new investors into this bank on profits going forward. But that's not the point, I think, where many banks are now. It would be very hard for banks to tap the market for new capital, and that's where the taxpayer comes in. And the taxpayer always has a preference, or governments have a preference, for distributing these losses over time rather than realizing them up front. Microphone? Yeah.
One more question.
Actually, these are two questions but related. First, it seemed to me implicit in your discussion that you would consider that Greece should remain within the European Monetary Union. And if that's the case, and you mentioned the restructuring of Greek debt, are you thinking in terms of a real restructuring by reducing the principal amount of the debt, or more of a rescheduling, as was done, say, in the case of Russia? If that's the case, how does Greece grow out of the situation it's in while remaining a member of the monetary union? And the second question, just in terms of recapitalizing European banks, I was wondering where the capital is going to come from. You said one shouldn't think about the BRICS, but is it conceivable that sovereign wealth funds in places like China, Russia, and not only those, but Indonesia, the Middle Eastern countries, would actually be acquiring, in effect, a controlling position, if not a majority position, in some of them, in Paribas or some of the major European banks?
Right. Well, on the first issue, I think it can be any of these actions. Actually, when I was still in the Bundesbank, we made a proposal for exactly the reprofiling. What we said is, because a lot of this debt is short-term, it should just be transferred into a much longer 20, 30-year maturity at the same rate of interest. Now, that was, at that point in time, that was my preference. It was actually more about the reprofiling. If you saw the amount that are needed to be rolled by some countries like Greece, it just has big operational risks to come back with such big issuance every year when spreads have gone up like they have. So basically taking the country off the capital market for a long period of time by committing to much longer maturities by the current bondholders is one way of endogenously reducing the value of their exposures to that country, and probably it is a softer way for restructuring debt than actually taking a big haircut and hoping that after you realize the haircut, new investors would come about and secure current market access. That way you wouldn't need current market access because the old bondholders would simply have a standstill agreement over a long period of time, and so that was originally my preference. You asked about my preference. On the second issue, I think it's very hard to make a general statement about who would invest in banks. I think you will find banks that have not all banks came through these problems with really being impaired. You had some banks that did quite well. Not all European banks needed to be rescued. And actually, some of the European banks that didn't have a huge exposure to peripheral debt, but had more granular exposures, and that could afford to realize a loss by selling them in the market, even when the market was trading much lower, did so. So there are some banks, this is what the European stress test has shown you. Yes, a large part, maybe almost 2/3 of the banks are in that area that is orange or red, but there are other banks that are doing really well. And I think heterogeneity of banking strategies will cause the fact that some banks will not have a problem, even if they're European banks, to fund in the market and to find new investors for capital. The problem is those that have the problem will not find those new investors, and that's where the taxpayer has to come in. And I think there, an action that reduces the size of those banks rather than recapitalize them to keep their current balance sheets going is a preferable option. Because let me remind you, in a market economy, success is as much a feature of a market economy as failure. If we prevent failures in market economies, we're setting long run totally the wrong incentives to do prudent risk management, to do prudent investment decisions, and to have banks face the long run consequences of their investment decisions. So I'm not in favor of finding bailout solutions. I'm actually in favor, where possible, wherever possible, to let investors face the consequences of their decisions and for the state to play a mitigating role to prevent contagion and to actually step in when a full-fledged crisis may emerge from doing what, in terms of economic policy decisions, are actually the right, prudent, long-run decisions. Let investors face the consequences of their long-term decisions. And nobody can tell me that in 2005, 10 basis point spread of Greek bonds over German bonds was anywhere near an approximation of the ability of the two countries relative to one another to raise funds in the market and repay the principal when it's due. If that is the case, it simply boils down to an exuberant environment that fostered at the time wrong investment decisions. Well, why ask the taxpayer to be on the hook to work out those wrong decisions? I think he may have to step in to prevent systemic crisis. He may have to step in to facilitate an orderly unwinding of banks' balance sheet. But let it be also perfectly clear, at the end of that process got to stand the orderly unwinding of the balance sheets of those banks that are in the weaker part of that distribution. If we don't do that, we basically grandfather everyone, and that would be, in the long run, leading to a much less competitive system in Europe, and I think it would just be the wrong way to go.
I'd like to thank Professor Brunnermeier for inviting our speaker, and thanks very much for coming and for simplifying things for us. I think it was very clear, very good lecture. One announcement before we thank Dr. Weber is we do have a reception out in the Schulz cafeteria, and everybody's welcome to come. But thank you very much.